Are you ready to take control of your financial future and build wealth, regardless of the economy? The key to long-term financial success isn't just about saving money. It's about making strategic decisions that can weather the ups and downs of market conditions. In this video, we'll explore the top 5 financial strategies that work in any economic climate. These strategies are designed to help you grow your money, protect your assets, and build a stable financial future. Whether you're just starting out or already on your financial journey, these strategies will help you stay on track and achieve your goals. Let's dive in. 1. Broad multi-asset diversification, leveling risk. Relying on a single asset class is risky, especially in times of market uncertainty. Diversification is key to mitigating that risk. By spreading your investments across different asset types, you reduce your exposure to any one market shift, ensuring your portfolio remains stable even in volatile conditions. Diversification works to balance out the lows of one asset class with the highs of another. A well-diversified portfolio includes a mix of growth assets, such as equities from sectors with strong potential like technology, healthcare, or renewable energy. These industries are expected to continue expanding, offering opportunities for significant returns. However, relying solely on equities can expose you to volatility, so it's crucial to complement them with more stable investments, such as high-quality corporate bonds or government securities. These fixed-income assets provide steady returns with lower risk and help stabilize your portfolio, especially when stock markets experience turbulence. Incorporating real assets like gold, silver, or other commodities is another critical aspect of diversification. These assets often perform well when inflation or currency devaluation causes other markets to struggle. Gold, for example, has long been a reliable hedge during times of economic instability. A diversified approach allows you to adapt to changing market conditions. When stocks are down, your fixed income assets can cushion the impact, while growth stocks can generate higher returns when markets improve. By balancing these assets, you're building a resilient financial strategy that can weather various economic conditions, providing long-term security and growth potential. 2. Strategic liquidity management, cash buffers. Liquidity is essential to your financial well-being, regardless of economic conditions. It provides the flexibility to handle emergencies, unexpected expenses, and capitalize on investment opportunities without needing to sell your long-term assets at a loss. In an uncertain economy, having readily available cash can make all the difference in protecting your financial future and maintaining your stability. Begin by establishing an emergency fund that covers 3 to 6 months' worth of living expenses. This fund should be parked in a high-yield savings account, HYSA, or money market fund, where it's both accessible and able to earn interest over time. While this emergency fund is critical, liquidity management goes beyond just setting aside money for emergencies. You should also aim to maintain extra cash reserves to take advantage of investment opportunities, especially when market conditions are favorable. For instance, during market corrections, having cash allows you to buy undervalued, high-quality assets, positioning you for long-term growth at a discount. A well-managed liquidity buffer gives you the peace of mind to avoid making hasty decisions, especially during times of financial stress. It enables you to sidestep selling investments during market downturns and provides room to recover from sudden financial setbacks, like an unplanned medical expense or a temporary loss of income. By keeping a strategic cash reserve, you gain not only financial flexibility, but also the ability to make informed, opportunistic decisions in both good and challenging times. Ultimately, this strategy strengthens your overall financial resilience and helps you stay on track with your long-term goals. 3. Actively protecting purchasing power, inflation hedging. Inflation erodes the value of your money over time, making it harder to preserve your wealth. In order to protect your purchasing power, it's important to actively hedge against inflation. There are several strategies that can help safeguard your money, especially in periods where inflation is expected to remain high. One of the most effective ways to protect against inflation is by investing in Treasury inflation-protected securities, TIPS. These bonds are specifically designed to keep up with inflation, as their principal value is adjusted based on Consumer Price Index, CPI. This means you'll earn interest on an amount that grows with inflation, preserving the value of your investment. Another great strategy is investing in dividend-paying stocks. Look for companies and sectors that have strong pricing power, like energy, utilities, and consumer defensive industries. These sectors are more likely to pass on rising costs to consumers, ensuring that their profits and your dividends remain stable. In addition, companies with a strong dividend history tend to be more reliable during times of economic uncertainty, making them excellent choices for long-term inflation hedging. By combining these strategies, you'll be able to protect your purchasing power and ensure your investments remain strong despite inflation. Additionally, protecting your money from inflation can help you meet long-term goals like buying a house or saving for retirement without having to worry about rising costs depleting your savings. Ultimately, these measures can make a significant difference in maintaining the real value of your money. 4. Aggressive debt reduction and optimization. Debt can quickly derail your financial progress, especially when it comes with high interest. High interest debt, such as credit card balances, payday loans, and personal loans, can make it harder to save and invest for the future. The longer you carry this debt, the more you pay in interest and the more it slows your financial growth. The key to getting rid of debt is to be aggressive in paying it off. Start with high interest debt and use the debt avalanche method to prioritize paying off the balances with the highest interest rates first. This will help you save money on interest over time. Once you eliminated the high interest debt, you can focus on other debt, such as student loans or mortgages. Additionally, if you have variable rate debt, consider refinancing it into a fixed rate loan. This helps protect you from future interest rate increases, allowing you to lock in more predictable monthly payments and maintain financial stability. By refinancing, you can secure lower rates and save even more on your debt payments over the course of the loan. By eliminating debt quickly, you'll free up more money to put towards savings and investments, accelerating your wealth-building journey. The faster you can reduce your liabilities, the more you can focus on growing your assets. This process not only improves your financial discipline, but also contributes to long-term financial freedom, where you're no longer bogged down by interest payments and financial obligations. 5. Automated goal-based investing, long-term perspective. One of the most important aspects of financial success is consistency. To ensure that you stay on track with your long-term goals, automate your savings and investment contributions. Automating your investments takes the emotional aspect out of the process, ensuring that you're regularly contributing to your future without having to make active decisions each month. Start by setting up automatic transfers from your checking account to your investment accounts, such as your 401k, IRA, or other retirement funds. This ensures that you're consistently putting money aside for your future, regardless of market conditions or how you feel on any given day. The simplicity of automating contributions makes it easier to stick to your financial strategy and avoid the temptation to spend. Additionally, consider using dollar-cost averaging DCA as an investment strategy. With DCA, you invest a fixed amount of money at regular intervals, regardless of market conditions. This allows you to buy more shares when prices are low and fewer shares when prices are high, helping to smooth out market fluctuations over time. By automating your contributions and using DCA, you'll be able to grow your wealth steadily and take advantage of compound interest. By automating your investments and taking a long-term perspective, you'll build wealth consistently without getting distracted by short-term market volatility. This approach keeps your financial goals in focus and sets you up for long-term success, while also giving you peace of mind knowing that you're making progress towards your retirement and future financial goals. There you have it. 5 strategies that can help you take control of your finances and build stability, no matter the economic conditions. From diversifying your assets to automating savings and debt reduction, these strategies are designed to work in any environment. The key is consistency and long-term planning. Start applying these strategies today and watch your financial health grow stronger. If you found these strategies helpful, make sure to like, share, and subscribe. These steps are designed to help you manage your finances and build stability, no matter what the economy looks like. Let me know in the comments which strategy you're most excited to try first. I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next video.